Which S&P 500 ETF is best for you to pay you that monthly income and potentially giving you some additional growth? Well, we took all 6 of the major brands and put them to a test to find out which one will fit right for you. Hey everyone, welcome back to the channel. I'm Doug, the retirement guy. If you're looking for income from the S&P 500 using those monthly ETFs, don't a lot of them all look alike? Until you really dig deeper into underneath the hood to find out that they all operate totally different. It's kind of an interesting thing. This is why we put this video together. These funds all look similar on the surface, but when you look under the hood, you get a totally different view. Some prioritize stability, others use maximum income, and there's a few that use heavy return of capital to meet their distribution targets. Today, we're going to take a deep dive into the majority of the major monthly paying S&P 500s, breaking down how each of them generate income, the risk that you need to understand, and each of the fund best suited for. Now, I'm not going to pick a winner. This is really going to be dialed into matching the right fund for the right investor. Let's get into today's video. So the hidden differences in monthly ETFs. First off, they all use the basic same core, which is the S&P 500. They all produce monthly distributions. So that's what you're looking for. You're looking for that income side of it. Here's 4 different funds on the screen, and each one of them is actually totally different. Jeppy, Spyi, Xpay, and Ivvw. Each one is a different type of fund. It provides risks that vary from conservative to aggressive. Income generation methods differ from each and every one of them, and each fund serves a different investor's needs. So it really leaves people questioning, I think I'm investing in S&P 500, but are you investing in the right one? So before we go any deeper into this, I gotta say this presentation is provided for educational purposes only and does not constitute financial advice. It's for educational purposes, no financial advice, distribution risk, and always contact a professional. I am not a professional. I'm a retail investor, very similar to you, except I've been doing this since I've been 27 years old. So let's take a first look at the first fund. Now this is the Conservative Income Builder, JEPI. It's the JP Morgan Equity Premium Income ETF, probably one of the longest running funds out there for the S&P 500. It's recognized as the grandfather of it all. The portfolio. Jeppy's holds the portfolio of large U.S. equity securities broadly aligned with the S&P 500 index. To generate its income, it generates sales of equity-linked notes, which capture option premiums. And then the equity-linked notes enable the covered call strategy, providing recurring cash flow to the fund. So what this does is it reduces the volatility, managing to achieve a lower volatility compared to the S&P 500. It has that stable monthly income potential, trying to provide distributions through those equity notes versus selling off of its assets. And the lower drawdowns. It demonstrates reduces losses during market stress periods. If you look at the performance of the fund over the past year of 8.7%, 5 years 9.76, and since inception 11.89. So it has a long-term history of providing a decent return. When we look deeper under the hood, you'll see $41 billion in assets. Expense ratio extremely low at 0.35%. They have over 726 million shares outstanding. Now this one here had a distributions of $4.72 for the past year, which gave you that 8.15% dividend yield. It pays out monthly, as we've talked about. Now here's the thing. Look at the growth. We had the April 2nd drop off, and you'll see this pretty much on every one of the funds that you see the April drop off. And the question was, how quickly did it recover? And you can see this one has recovered out of the April, recovered fairly shortly, I'll say a 30-day window, and then recovered and stayed at that point. So for year-to-date growth, they had 0.43%, which in most people, it's probably okay with a slight small growth, but you're getting over 8% in distribution. So your total return is 8.58%. Look at the distribution chart. It has had some spikes and some off periods, I'll call it, but fairly smooth across the board of giving you a minimum of about 40 cents per week or per month. So again, a very conservative, very simple process to operate. Our next one is one of the bigger, newer ones that's been out there, Spyi. Now, this is a higher income, but it's got more complexity on how they create that. This comes from the NEOS family of ETFs. This is their S&P High Income ETF. Now, this one employs a more aggressive strategy to generate monthly income compared to Jeppy. It's focused on capturing high option premiums through direct implementation of covered call strategies on S&P 500 index options. Historically higher yields than Jeppy with the higher monthly distributions. Now, why and how do they get this? They actually do full-blown covered call strategy directly on the S&P 500 index options. Options management, they buy calls when the market conditions warrant, and income focus. This is a 100% income focused type fund to capture the higher option premiums. So what they're doing here is they're buying options, they're buying all different places, trying to generate as much income as they can. Now here's the differences. There are more NAV sensitivity in the volatile markets. So when we talk about this, and you've seen this on, probably if you've watched, you probably see YouTube, you see different people talking about it. I've talked about NAV erosion, NAV, which is your net asset value. So when a fund has that high volatility, or we call sensitive volatility, you're going to see your NAV drop off. You're going to see the growth side fall off more than other funds. But its great reliance on option premiums gives you that larger distribution. Plus, it also includes return of capital, which is how it manages more of its tax purposes. They also use that 60/40, 12/56 contract side of things, which helps control taxes down the road. Now, we look at their funds. 1 year, it's been 16.6, since inception, 14.8. So again, we're almost double what we're getting out of Jeppy. When we check under the hood of this one, $6.92 billion in assets, so heavy liquidity. So it's, you don't have to worry about that side. We look at 131 million shares outstanding. Now, 11.58% distribution yield with a $6.15 payout per year. Okay, it does still pay out monthly. And look at the chart. Again, came up April 2nd. Quickly, within, again, less than 30 days, it's recovered and it's come back and actually have grown. So your growth has actually gone to 3.19%, giving you a total return of 14.77%. Now, when we talk about distributions, look at the distribution rate compared to the last one we just seen. It has less peaks, less spikes, and more consistency across the board, and pays out a little higher number. This all comes from the risk of doing more option trading. Now, a similar package, which is Tap Alpha's Tspy. This is their SPYI growth and daily income ETF. Now, watch out that wording. That is not giving you daily payouts. It's not giving you weekly payouts. It's still doing monthly payouts. But what they're doing is they're resetting their option covered call strategy on a daily basis. And I'll explain that here shortly. Tap Alpha is an exchange traded program that mostly invests in large cap equities. The fund is actively managed, which is very critical, aiming to provide a balanced approach to growth and income. So give you more of a balanced approach on this one. So where I told you earlier that daily income, well, what they sell is what we call 0 DTE covered call strategies, which means they have virtually 0-day expiration dates. So we're working at this. It's kind of like an overnight event. So they set this as today is the last day that you can get this covered call. They price it accordingly. And they're going for that extra overnight, extra hours with that covered call strategy. It's an extremely aggressive program, but we've seen it, and it worked very well for many investors and also for many of these issuers like Tap Alpha. The options management, it buys calls in the market conditions and sells those covered calls of the S&P 500. Now, the income focus on this is very high because they're using those 0 DT covered calls. Look what the numbers are, 16.87 and 18.41 cents inception. This fund's about a year old as we speak now. When we go under the hood of this one, because it's a newer fund, it only has the $175 million of assets under management. So it's slowly growing still. Expense ratio a little higher at 0.77%. Has over 7 million shares outstanding. When you look at the chart, look at again, April 2nd. Look at how it recovered. It was a quick spike and then dropped and then slowly came back out again. So it has recovered. The difference though, like Jeppy, it's only had a growth of 0.16% growth, but the distribution yield, 13.72% with a $3.50 per share payout. That gives you a total return of 13.88%. So we look at their chart. They've had a couple little spikes, but more importantly, starting to have a steady growth on that dividend. So this is more aggressive of a system than Jeppy. It's definitely more income oriented than SPYI, but SPYI's had also the additional little bit part of that growth side of things. Now we get into Xpay. This is from Roundhill. Now I call this one the maximum income strategy, targeted strategy. Their annual target that they promote is they're trying to get a 20% annual distribution. This one is all about cash flow over total returns. I'm going to put my own personal opinion on this one. I'm not an excited fan of this one, and I'll tell you why. At 20.88% current yield, this is one for people looking for big potential income. Their flex option focus, it invests 80% of its net assets in flex options. And that's referencing the Spider S&P 500 ETF. Active distribution management and return of capital mechanism. It's used a return of capital to continue two things. One is to continue that you get distributions paid out, but again, that's coming out of your own pocket, and then also using it for tax purposes. So it relies heavily on the return of capital to achieve distribution targets when market income is insufficient. Now, the risks of this one, the distributions often exceed the portfolio's income. That's where that return of capital comes in. It relies heavy on return of capital, NAV erosion over time, and market condition extremely sensitivity. When you look at their distribution strategy, the flex options, 80% of their portfolio, they're putting out in options. Okay, they're doing things that create those options because they want income, income, income. Income comes first, everything else is second. And they hold 20% in cash reserves to refill that 80% bucket. How is that done? In 1 year, they've had a 16.99% return. Since inception, 17.17. So your question, where's that 20% current yield that we talk about? Well, you got to check underneath the hood. So the Roundhill S&P 500, the targeted 20 managed distribution ETF, Xpay. They have assets of $77 million. Okay, they have a distribution of $11.43 paying out. And this fund has a dividend yield of 20.88% at today's numbers. Okay, now those numbers will always change because none of this stuff is guaranteed. No distributions are guaranteed. But look at what we have down below, the growth, negative 5.67% over past year. This is why on the channel, I've always preached and will continue to always preach, your real answer is total return. Don't chase yield. This is what people do at the start when they're getting into dividends. Chase yield. This is simple. I'm going to buy this fund because I'm getting 20% when everyone else is showing me 8%, 10%, 13%. I'm getting more money here. But what you have to do is you take your distribution yield plus or minus your growth to give you your total return, and your total return is only 15.21%. Now, I know I say only 15.21% because that sounds like a great number, but they're advertising and promoting a 20% target and a 20% yield. We look at the fund, very similar to what we've seen in many of them so far. Dropped in April, recovered, came back up, and it's had a little bit of a rocky road, but never got back to where it was back in February. That's why you see that negative 5.67%. Now, people who bought this in April are smiling because they don't have that growth. They've had major negative growth. They've had major positive growth. But look at the distribution that Xpay does. And this is normally a telltale sign that you can look real quickly and say, well, let's look deeper. Does this have a return of capital? How do they use it? They have a flat line distribution, paying out about 95 cents per month per share. And it's flat straight across the board. How do you get straight across there? Because you balance it out using the return of capital. You may have income come in 1 month, you pay out 95 cents. If you didn't have enough money to cover it, you do the return of capital. All of a sudden, next month, you have more money. You only pay out 95 cents. You put that back into your assets under management, in the capital. So one thing on this fund you always want to watch is going to be the assets. Watch the assets. Is it going up or is it coming down? The more it comes down means you're digging deeper into the fund. Now we get into a new one, Ivvw. This is a classic buy right approach. Now this one holds S&P 500 exposure and systematically sells at the money call options, generating income while maintaining market exposure. Now I've had a lot of people ask, what is that at the money call? So let me show you in a quick diagram here. If the black line is the price of S&P 500. With a little bit of volatility, you'll see the line going up, down, up, down, up, down. What they're trying to do is probably a better word of timing the market. So what they want to do is buy on the downward strike and then sell at the basically either at the peak or on the peak's downward trend. So what you have to know is the current wave of S&P 500 to find the right time to put it into place. It's a rules-based approach to cover call writing. So it doesn't really use that managers, it's a rule that's written that almost anybody could sit in a seat, follow the rules, and generate the cover call writing. It sells at the money options for that S&P 500 exposure and generates income by monetizing option premiums. Now, this one's going to have a lower expense ratio compared to many others and historically a strong income during sideways markets. So it's transparent and systematic option style. We look at this one 1 year, 11.33% and 13.9% since inception. Let's pop the hood. So how Ivvw works, again, is it's doing a very strict rule-based process. Now, the strengths of it, the clear rule-based strategy is very transparent. It's very systematic. It's great in those sideward markets. It's moderate bull markets, does okay. In a strong market, it's probably where it's weakest. And in bear markets, it's kind of off. It needs the volatility is what it needs. That's why they use a low expense rate because they don't have much they don't have much expense because anybody could actually do this. But it caps the upside in bull markets. This is why the better the market is, the worse this one will do because it caps its upside. It can only go so high. So when we look underneath the hood of this one, you got $214 million in assets. Now the expense ratio is 0.25, probably the lowest we're going to see across the board. Now the share prices, or shares out, are 4.72 million. It's collected $8.45 this year in distributions for an 18.46% yield. But again, don't let that one scare you because we're going to show you the numbers down below here. The growth is off 7.36%. So with a great 18.46% in distribution, you only have a total return of 11.10%. You look at that April 2nd drop off. This is where the capped upside has not done well. It's collected distributions, don't get me wrong. April 2nd, it dropped off. It recovered back to not really a set point, but a point. It didn't really grow after the April 2nd repair. But it collected those distributions because we've had what they classify as a sideways tight market. We didn't have a bull market. We didn't have a bear market. We had a sideways tight market. And this one loved it, but that potential is lost its growth. Look at your distributions. Distributions are up and down, all based on the market volatility. And last month we had huge volatility in this category, and they collected almost over $1.50 a share. And then we go into Qdiv. Now, this is a conservative approach dividend. Qdiv works with focusing exclusively on qualified dividend paying S&P 500 stocks. The income derivative directly from corporate dividends. There's no option strategies, avoiding options related risks. Distributions are backed by actual company earnings. The strength and trade-offs. There is no option strategy here, so there's no real risk out there. It's a lower volatility profile, and sustainable income is backed by the company fundamentals. Now, the lower yield than option-based funds, and the income growth are more slowly. We always say this is best for the conservative investor, and that dividend pursuant income, and it's a long-term growth factor. Look at the numbers. We've been talking about different numbers, and we see everything pretty much has been 8 and above with a lot of teens in there. 1 year, 5.4. 5 years, 9.6. And since inception, 8%. When we pop underneath the hood of this one, $30 million in assets, 0.20 expense ratio, 880,000 shares into the fund. When we look at the hardcore numbers of this thing, you will see the growth, 1.04%, 3.10% distribution rate for a total return of 4.14. As much as this is a solid, secure, safe fund, it still had the April 2nd drop-off. It recovered, and it's recovered with its upside. But again, with no real option tradings, or they're just collecting dividends from the S&P 500 funds, you see that they pay out a very small percentage and very small number each and every month. Like you said, $1.09 for the total year per share is what they paid out. So putting this all together, what does it mean? Where are we at? How do we fit? What does it explain to me? Well, I'm going to go through this fairly smoothly with you. Remember, I'm going to start the acronym. Total return. Total return means everything. We go out and talk about Xpay paying a 20% yield. Well, Xpay, I said earlier, I'm not for Xpay. It's not one of my favorite funds, but there may be people out there wanting that 20%. But your total return this year, 15.21% as a total return. When the next fund in line is Spyi, because it gives you yield and growth. Then the third fund comes into Tspy, 13.72%. If you're chasing yield, your options are going to be Xpay, Tspy, Spyi. You're going to be looking at those. You're going to be looking at Ivvw. And realistically, when you look at total returns, the numbers all flip. Everything changes. So when we look across the board, and I put it down below, so some people love the pie charts as well, is that you can see the ones with the total growth. Well, Spyi has the best total package of giving you growth and income. So if you want lower volatility, if you're one who just wants to wake up and know that your money is you're not seeing your balance changing much, Jeppy is going to be a great fund to investigate for you. Do your own research, but Jeppy would be where I would head to. If you're looking for higher income, I would be looking at Spyi because of that total return number. You just want maximum yield, you want to chase that yield number, then you want to look at Xpay. That one's going to give you the biggest potential for income across the board because of that targeted 20 system. But you have to know your NAV is going to be dropping. You're going to have some negative growth onto it. You have to time it right. There's a lot of pieces of that puzzle to make sure that you can maintain that 20% yield. Systematic income, well, that's going to be Ivvw. Nice 18% yield, but down 7.36% in the growth. That's all from that systematic type system. And if you're looking for just pure dividends, I'm not looking for high risk. I'm not looking for, I just want income, and I don't want to buy all these different funds. Then Qdiv gives you the income of the S&P 500 with some growth and just a nice, again, conservative package. So the key decision and factors to the ETF selection is your risk tolerance. Now, Jeppy is going to have a low volatility and capital preservative, so it's going to have a low risk, while Xpay is going to have a high risk with that potential NAV erosion. Your income needs. Where do you want your income? You got Jeppy is going to give you a stable, moderate income, but it's going to be lower numbers, while Xpay is going to give you the highest yield, but uses a lot of ROC to achieve it. Your time horizon. Short term, man, you could jump in Xpay, get some high distributions quickly, generate some money, get out. Or long term, again, Jeppy's with that stability. Or even to me, even with the Spyi is in that time horizon. And an options comfort level, if you have a managed process, if you have someone doing it, managing the option side of it, then option comfort level changes because people are doing it, the professionals are doing it work for you. So Qdiv has no options at all, while Xpay uses high option strategies. So it just kind of shows you that the risk factors out there change from fund to fund. So that's why you have to understand what exactly is your financial goals, your risk capacity, and your investment timelines. These are all things that change which funds to buy. So recap again, there's no universal best monthly paying S&P 500 ETF. Not a single one of these. And I said that at the beginning. I wasn't going to clarify a winner or a loser. It really is designed to which fund is part of it. And I really dialed this thing into because I've looked at a lot of different people's portfolios. And when we talk about it, they all have different reasons. And I've seen so many people have 2, 3, 4 of these different funds in their portfolios. And I just really had to ask why. So I wanted to do this and share this with you guys. Is the key selection factors is risk tolerance. How much risk and volatility can you accept? How much income do you need? Do you need that monthly cash flow? What does it require? What's your timeline? If you're looking for a quick, short income, or are you a retiree that wants long-term income? And are you comfortable with options? Are you familiar with these different strategies? You need to understand what's in your ETFs. It's not just buy it because of a number. You got to buy it so that you understand exactly what's going on. Match your profile with the right ETF. I'm going to help again. Jeppy is great for conservative investors seeking the stability. Spyi, those are seeking higher income with moderate complexity. Xpay is for investors prioritizing maximum cash flow, don't care about the growth, don't care about anything else other than income. Ivvw, those are comfortable with systematic option strategies. And Qdiv is for the people who I just want to collect dividends from S&P 500. I don't care about anything else, just whatever the companies are paying. There's 500 plus companies out there. I wanted whatever dividends come from each and every one of them. So guys, the next step is access, your financial situation, your investment goals. Consider consulting a qualified financial professional to determine which ETF actually aligns with your overall profile and objectives. And then you can choose the right one for it. Hey, let me know in the comments below. Did you pick one of them? Are you a Jeppy? Are you a Spyi? Who are you? Are you a top alpha type person? Let me know. Do you like this setup the way we've done it? We're not having a true winner. Let me know in the comments below. And best off, if you want to help the channel, hit that like button and hit that subscribe. We'd love to have you as part of the family.